Are you sure?
Here's the 30-second lesson on what legends know. Never ask a bride why she's getting married. Don't wear a skirt on a windy day. Deodorant is not a shower. Don't sniff chili flakes. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at The Print, and this time we're going to be discussing the decision of the Monetary Policy Committee, the first such decision after the presentation of the interim budget, and what the Monetary Policy Committee has to say about inflation, growth, and the outlook for the next year. And to discuss that, we have with us Radhika Pandey, Associate Professor at NIPFP. But before we start, I had an appeal to make before you, which is please do subscribe to The Print, because it's through these subscriptions that we can bring you the stories from across the country that we've become so good at doing and that you appreciate from us. It also allows us to do discussions like this. But apart from that, it gets you a whole bunch of benefits. For one, it gets you access to our subscriber exclusive webinars, where we talk to a whole range of panelists on a wide variety of topics you shouldn't miss out. It also gets you the ability to write into us in our Your Turn section, where we publish your opinion on our portal. And finally, it gives you access to the newsletters that are written by our editors, which come straight to your mailboxes, analyzing the news of the day. This is also not something that you should be missing out on. So please do subscribe. The link is in the description of this video. Thank you. Now let's get on with the discussion. So now, Radhika, let's start with first what the MPC, what they decided this time around, and regarding the rate and also their stance.
Yeah, so on both the rate and the stance, they left it unchanged.
Right.
And it was widely expected that given that inflation though has come down from the highs that we saw in 2022, it is still above the medium-term target of 4%. Therefore, RBI would like to maintain a status quo on the policy rate. So
Right.
it has, the RBI's Monetary Policy Committee has decided to keep the policy rate unchanged at 6.5%.
There was also some talk that maybe with the elections coming up, they might cut rates just to give a boost, pre-election boost, but that has not happened.
Because, growth is still resilient.
Right.
We saw in the first advance estimates, the growth for this financial year is projected at 7.3%. Even for the next financial year, growth is estimated at 7%. So there is really no need to give any stimulus in the form of interest rate cuts at this moment, because growth is resilient and underpinned by services. Bank credit is going strong. So there was really no need to provide that kind of a stimulus through interest rate cuts. And in fact, that could have acted as a premature easing, and it could have led to de-anchoring of the household inflation expectation.
Absolutely.
Which is a very important task of inflation targeting regime, that is to anchor the household inflation expectation. So I think to that extent, it was a prudent move to leave the policy rate unchanged as at 6.5%.
And the stance?
The stance also is left unchanged at withdrawal of accommodation.
Right.
Again, this is in sync with their decision to maintain a status quo on policy rate, because they want to maintain some kind of deficit in the liquidity through withdrawal of accommodation, through withdrawal of liquidity, so that the interest rate, the money market rates remain on the upper side.
Right.
So that is the reason. So that will again help in aligning the interest rate with the inflation, and that will also serve as a measure to counter the rising inflation expectations.
Okay, but this time around, I noticed something interesting, that this is the sixth time that they have kept rates unchanged, 6 times in a row. In the last 2 times, if I remember correctly, the decision was unanimous.
Right.
But this time around, there was one sole dissenting voice. 5 of them said we should keep it unchanged.
Right.
One said that we should cut it by 25 basis points.
Right.
Now, do you feel that this in the next few meetings,
Yes.
there might be more people who say that maybe we should consider cutting. There'll be a larger discussion about rate cuts.
Yeah, so what the dissent we had already seen earlier was also, but that was on the stance. You know.
Yes.
Professor Verma had dissented on the stance, and he has been saying for like 2-3 meetings now that the stance should now shift from withdrawal of accommodation to neutral,
Right.
and that should set the stage for interest rate cuts in the subsequent meeting. So that is how it proceeds. But again, he was the sole dissenter, and
This
most
time on
of the-
rates.
Yeah, so till now he was the sole dissenter on stance, and now he has progressively moved to being a dissenter not only on the stance but also on the rate that
Right.
he voted for a cut in interest rate by 25 basis point, because the point here that he is raising is about the real rate of interest. So what is real rate of interest? It is the nominal interest rate, that is the policy rate, minus inflation. So if the real interest rate is very high, it could lead to suppression of demand. So
I see.
and it could lead to slowdown in the economy. So there is this understanding that real rate of interest should not be allowed to rise too much, because if we keep the interest rates elevated and if inflation edges down progressively, then your real rate of interest, which is the difference between interest rate and inflation, that will increase.
Right.
And that will hamper demand, and that could lead to some measure of slowdown. So there is that was his thought process, that there should be a move to now start cutting interest rate. But most of the other MPC members voted to maintain a status quo on interest rates, given that inflation still remains elevated and there are a lot of uncertainties on inflation at the current moment.
I was actually going to, that was my next question on inflation and the outlook. It's not certain that the real interest rate is actually going to widen, right?
Absolutely.
Because we don't yet know with certainty if inflation is going to fall.
Absolutely. And, if we look at the food inflation, there are a lot of headwinds to food inflation, because even if we look at the overall headline inflation till October, it was declining, and
Right.
then the trend got reversed in November and December because of the rise in food inflation. And if we talk about the outlook, now there are some positive points, there are some negative points. Positive things is that, the Rabi sowing has improved and it has surpassed the last year's level, which is good.
Okay.
But the point here is that it could be, again, the productivity could be impacted due to the adverse weather events that we are seeing.
Absolutely.
So El Nino impact could play a role in hampering productivity, and that could lead to, again, some upside risks to food inflation. Also, if we look at the daily food price data which comes from the Department of Consumer Affairs, Ministry of Food, we still see that cereals and pulses price remain elevated. So even though there is a seasonal decline in vegetable prices, but cereals and pulses still remain elevated. So domestically, these are the problem, and internationally we see oil prices, which were showing a downward trend, again have rebounded.
There's so much going on in the
There's so
world
much
that
going
affects
on. Yeah,
energy
so
prices.
Brent crude oil is again above $80 per barrel because of a strong US economy, because of some optimism around the Chinese economy rebound
Right.
in demand, and also because of the US military attacks at the Middle East and
In the Red Sea
area. So that is causing some concerns about supply side bottlenecks, leading to an inching of global crude oil prices. And so all these could shape the inflation trajectory in the coming months. So it's very uncertain, and
Right.
I think it's a prudent move to wait and watch and not go in for a premature easing of interest rate cuts.
Possibly that's why there was one dissenting voice.
Yeah, and even globally, if we see US, EU, UK, all of them, in all these economies, inflation has durably declined from the highs of 2022, but over the last few weeks, we have had monetary policy meetings of all these three economies, and
Right.
all these central banks have voted to maintain a status quo.
Right.
But interestingly, again, in the UK also, there is a dissent. So there is a dissent happening because this trade-off becomes complicated towards the end when you are, moving, as the RBI governor used the term, last mile of disinflation.
Right.
So those things become a bit tricky, but overall, if we see, there has been status quo on policy rate, not only by the Indian central bank, but by other global central banks as well.
Absolutely. So now on growth, what is the Monetary Policy Committee saying? What is their outlook? From what I can tell, they seem to have upgraded their outlook for each quarter as compared to what they had said in December.
Yeah, so they have, so overall for FY25, the growth projection is at 7%, similar to what the Finance Ministry in its latest review of the economy before the budget, they also said that, it's quite possible that the economy could have a growth rate of 7% in FY25.
Right.
So the same thing is being echoed by the RBI's projections as well. And each of the quarters, the projection for growth has been raised. So it's mainly because of one is improvement in Rabi sowing. Second is, the demand for work under Manrega has gone down.
Okay.
So that is a good sign in the month of January. There are some signs of improvement in private sector capex, as is seen through capacity utilization data which the RBI has access to. Listed companies' performance is doing better in terms of, again, better profitability.
Right.
The government capex is going strong. Services are normalizing. So all these things have resulted in an upgrade to growth projections for FY25. And that's not just true for RBI. If you look at the international global agencies, all of them over the last couple of days have upped their projections for India's growth for FY25. OECD and even the credit rating agencies, they have upped the projections.
So when you and I have talked about the GDP estimates and all of that quite a bit, and in that the lone kind of dismal figure was rural consumption and the agriculture sector. So if these things are happening, if sowing is better and if Narega job requirement demand is less, then that's a very good sign for the economy.
That's a very good sign. And even if you look at some of the recent surveys that have been conducted on FMCG financial performance, they are also saying that, the gap between the rural demand and urban demand is bridging. Rural demand is picking up in terms of volume. So I think that the consumption is either stable or it is improving. So rural demand is also seen to be improving, and it needs to be seen. But sitting as of today, if one has to make an assessment of the state of the economy, I think it is resilient, it is strong, and that is the reason why the growth projection has been upped.
Okay, and now, as we mentioned in the beginning, this is the first Monetary Policy Committee announcement after the interim budget. How does the fiscal discipline that you and I have also talked about and that we've seen in the interim budget, how does that affect the ability of the RBI to perform its functions and its responsibilities?
Yeah, so monetary policy can now focus on its core mandate of inflation targeting, given that the central government is serious and focused on aggressive path of fiscal consolidation.
As we saw in the budget.
Yes, because we've seen that from 5.8%, they are budgeting 5.1% of GDP as a fiscal deficit for the next financial year. And going by that trajectory, the medium-term goal of 4.5% fiscal deficit by FY26 looks quite achievable. So it bodes well for the conduct of monetary policy, because if they would have gone astray from their fiscal consolidation roadmap, it would have resulted in higher expenditure.
Right.
Higher expenditure would have resulted in higher induced demand, higher fiscal expansion, and that could have made the task of monetary policy difficult.
Meaning it could have pushed inflation up.
It could have pushed inflation up. It could have further delayed the cutting of interest rates.
Right.
So now the trajectory of interest rates or the decision on when to cut the interest rate can solely be focused on inflation trajectory, given that the fiscal consolidation roadmap is being effectively managed by the central government and there are no spillover impact of those on the conduct of monetary policy.
Right. So it's good. Like everybody is doing their job basically.
Yeah.
Right. Now we have a question, actually a couple of questions from the audience. One of them is that in last year's budget, nominal GDP growth was estimated at 10.5%. But as per the advanced estimates given in the interim budget this year, nominal GDP growth is estimated at 8.88. What could be the reason for such a discrepancy in estimation?
Yeah, so when the budget figures are announced, we have a projection for the nominal GDP.
Right.
Now, that is just a projection on the basis of certain assumptions. So that's a projection. But when we come to advanced estimates, more than 8 to 9 months of data we already have.
I see.
And then we get an estimate for we get an estimate for nominal GDP.
Right.
So what the government had estimated at the time of presentation of budget last year was 10.5%. But what the advanced estimates showed was that the nominal GDP growth was 8.9%. And the main reason for this was the decline in the global commodity prices.
Right.
Because when we see what is the difference between the nominal GDP and the real GDP, that is being captured by GDP deflator. Right. So now, and GDP deflator is a combination of wholesale price indices and the CPI, the consumer price index. But it has a greater weightage of wholesale price index.
WPI, right.
WPI, which is accounting for the tradables inflation or the external inflation. So if the external inflation is coming down, or if international global commodity prices are coming down, as we saw, WPI was
negative for so long.
For so many months,
Yeah.
12, 13 months in succession.
Right.
So when WPI is in a contractionary zone, GDP deflator is bound to be lower.
Right.
And because almost 60% of the GDP deflator is driven by WPI, and if WPI is in the negative territory, GDP deflator will be lower.
Which means nominal growth will
GDP
be lower.
would be lower than what was thought at the time of the presentation of the budget. So that is the main reason why this number is was so off as compared to the nominal GDP growth estimate at the time of budget presentation.
The budget. Okay. And a follow-on question on that is that all I see on the internet is that India is exceeding its real GDP growth. But when inflation is high and nominal GDP growth is off by so much, how are we doing good on real GDP growth? What am I missing? He asks.
No, again, the same point here,
Right.
that firstly, inflation, if we look at CPI inflation, the last, for the December number, it is 5.6%. And if we see overall CPI inflation, it is projected to be 5.4% for the current financial
Right.
year. So if we have this as the inflation, and again, when we talk about nominal GDP and real GDP, the difference should be measured in terms of the WPI trajectory and not so much through the CPI trajectory. So now that WPI is slightly coming into the positive territory, therefore we are seeing that again the nominal GDP should be somewhere around 10.5%.
Right.
So, and for the next financial year, again, if you see the inflation projection is 4%.
Yes.
Okay, 4.5%. So considering a real GDP growth of 6% or 7%, and growth of an inflation of 4.5%, nominal GDP growth would be somewhere around 10.5 to 11%.
Yeah.
And that is what has been projected for the next financial year as well. So either it would be 10.5% or it could be even higher at 11%, and that would again be good for other fiscal projection, because
Absolutely.
fiscal projections will do better because your denominator is higher. It will again provide some kind of a support. So I think all in all, the nominal GDP growth estimate as of now look reasonable, look correct, because they are based on what is happening to the trajectory of both WPI and what is the projection for CPI in the coming year.
Okay, so there you go. What the RBI has done is that it's kept the policy rate unchanged at 6.5%. Its stance also remains the same, but the changes lie in its commentary. There's one dissenter to rate decision. Jayant Verma basically says that he feels the rate should have been cut by 25 basis points. 5 other members said the rate should remain unchanged, so it remained unchanged. On inflation, there is a lot of uncertainty still, and inflation still hasn't hit the 4% target that the RBI has and that they've been saying is their target. So until there is more certainty, the RBI is not likely to cut rates. The good thing is that the fiscal responsibility shown by the central government has allowed the RBI to now focus solely on inflation. And so any rate decisions it makes will be based on how inflation moves. On growth, some interesting things have been said and brought out by the RBI. The most important is that Narega job demand came down in January, and basically the rural economy seems to be doing a little better than it was. And now the thing is, if you remember from our previous discussions, it was the rural economy that was the sticking point. It was the rural economy that was doing slower than we would have liked. So seeing a recovery there is great news. But on that note, that's all from us. Thank you so much for watching.